Hey, so in this video, I'm going to show you how to do a proper fundamental analysis on Netflix. But I'm going to do this in a little different way, where we're going to watch Paul from Everything's Money stock analysis, so I can show you the common mistakes beginners make when they're first trying to start to analyze stocks and how you can do it correctly. Well, I'm going to be very critical towards Paul. If you didn't make these mistakes, don't feel bad because it's extremely common. I made these same mistakes when I first started trying to analyze the fundamentals of stocks, and it's all just part of the learning process. What's not okay, in my opinion, is acting like an expert, like Paul does, when in actual fact you're a complete beginner putting out a lot of, frankly, just very bad information that's going to most likely lead you to significantly underperforming the index. And probably why most people actually should just invest in an index fund of the S&P 500. From the background I could see is Paul's channel used to be towards real estate and business pre-2020, but then when the retail hype started in stocks, he flipped this channel into a value investing channel, even though he was never a serious stock picker and didn't even have a portfolio before 2020. Well, I do agree with the overall philosophy of looking at a company's financials and buying a company when it's undervalued and selling it when it's overvalued. In fact, this has been my overall strategy for many years now, which has led me to outperform the overall market. The problem is Paul seems to have a very beginner and surface level understanding. Think of this like a textbook example you would see in school, but in real life, the real life application is actually a lot more complicated. When you're reading financial statements, there's a lot of subtleties, and you need to interpret how they impact the specifics of the business, which I'm going to show you in this video. And remember, this is for educational purposes. I'm not a financial professional. And full disclosure, I do already own some Netflix stock at lower prices, and I am currently significantly up on it. And also remember to subscribe to my channel if you want to learn how to do more stock analysis in the future. And now let's dive into the video.
Yeah, so what was? And that's why I'm wondering what's his thought process now.
All right, so this is our stock analyzer tool. We use this to determine the future value of a company. We make assumptions. This doesn't include the balance sheet. We make assumptions on revenue growth, profit margin, free cash flow margin. Now, this is what I was talking about. Look at the difference between profit margin and free cash flow margin. This is 1, 5, and 10-year numbers. These are big differences, and it's pretty consistently across the board, big differences.
So the reason why I skipped 12 minutes in the video of a 19-minute video is because pretty much for the first half, him and his yes man Mo were pretty much going over why is the profit margin higher than the free cash flow margin? Well, this should be really obvious because in a business like Netflix, they've been spending a lot more on content every year. And when they're depreciating their old content and expensing it, there was less money they spent. So that's why the free cash flow is going to be lower, because they're depreciating last year's content, but they're spending money for this year's or next year's content. And you can see this if we just go into the amount Netflix has spent every year. It's very consistently going up and up and up with a new high every year. And eventually when they do just normalize and have a consistent amount they're spending on content every year and then amortizing the previous stuff, the cash flow, the free cash flow just become fairly equal when that happens. But when they're still in growth mode, you're going to see this disparity. So it's not a very big question. And you can also just see this in their financial statements themselves. If you go into the free cash flow, it's actually very, very obvious. Well, you have negative $16.5 billion here that's effectively going out of the cash flow that wasn't from the operations. This is the new money they're investing in the content, and then they're adding back in the depreciation, which was only 14.36. So when I say you have to understand how to actually read a financial statement without watching the first 12 minutes of his video where he doesn't understand, oh, we have to investigate it. Well, if you look at the cash flow statement, it should just jump out at you that this is very obviously what's happening. And we know when Netflix does mature, the free cash flow and their profit margins are probably going to normalize.
Problem. Then you have to assume your ending PE and price of free cash flow. And finally, and most important, your desired annual return. 10% is the market. I always put 10% in as what is this company worth? Because you can buy an ETF and make 9 or 10%. So that should be my bare minimum. The higher my desired return, the more margin of safety I'm giving myself, right? And as I make higher and higher assumptions, they're less likely to happen. So I need a larger margin of safety. So let me look at a 10-year number here. Let's go with revenue growth of 3, 5, and 7%. Profit margin. Let's go.
Okay, so first mistake. Where are these revenue growth numbers coming from? Like, obviously you need to have assumptions for all of these, but frankly, he seems to pull these 3, 5, and 7% numbers completely out of his ass, even though the last 5 years it was 20%, The last 1 year, it was 10%. This is with the slowdown that basically happened in tech from the little bit of the initial boom from everyone staying home and getting some extra growth there. So why are we choosing these frankly low numbers of 3, 5, and 7%, which I find it funny compared to another stock he did a few days later, T. Rowe Price, which is a company which basically does like mutual funds and stuff like that. They were averaging for the last 5 and 10 years about 6% growth, and he puts in numbers of 4, 8, and 12, which is not only higher than Netflix, but higher than their average. So when you're getting the revenue growth, one of the best ways to do it is typically go for a more mature company that has a lot of analysis, a lot of analysts covering it like Netflix, is just look at what the analyst estimates are. So at least here in my Guru Focus, we can get these numbers. I just go to, I like looking at it very visually, go to interactive chart, boom, pop up the revenue with estimates, and we can see basically how it's going to be growing. We got an estimate of like 34.2 billion, 2023, then the next year 38.4, and then the next year 42.2. And we can see these are fairly accurate. Again, these are just the ranges. So if we go to something like CNN Business here, you can see the overall range here for the next 2 years, which basically match up. It doesn't have the 3 like Guru Focus does, but the consensus of 38.4, a low of 35.9, and a high of 40.2. So for this overall growth rate, this is about averaging 10% a year. And it's slower in the first year because right now the market has priced in some economic slowdown. And then it's actually a little bit over 10% for the next 2 years. But to be conservative and kind of realistic, I think we should use 10%. And even though there's this argument, well, Netflix is big, how much more can they grow? Well, Netflix, frankly, is still somewhat of a growth company. They have a lot of possible expansions. If you go into their earnings report, you can see how Netflix views it. They look at their share of viewing time. So, and they look at Netflix only has a low percent in all these, and they want to expand that out. And they can do this in a lot of different ways. There's a lot of expansion opportunity in the rest of the world. So if we can go down the regional breakdown, you can kind of basically see where this is like United States and Canada, this is Latin America, this is Europe, the Middle East and Africa, and then Asia Pacific. I think I got that all right there. You know, they got their little abbreviations, and you know, you have to remember them correctly. So you can see basically the paid memberships in the US is being what it is. Maybe it can grow. There's 300, 30 million, I think a little bit more. Then there's Canada. So you're getting closer to even 400 million, and they got 74. But really where they can do a lot of this growth is just with upping the prices, which is what they're doing. But in Europe, the Middle East, and Africa, they actually have similar numbers of that too, but it's growing a lot more. So there's still a lot of growth there, but their average revenue per membership is lower. And that's basically the same with other countries of Latin America and Asia and Pacific. So there is a lot of basically growth Netflix can do, and especially with the up and coming of emerging markets and second world countries, as they start making more money, they can up the membership amount and therefore actually make a lot more. So you're not just in the US and Canada and, oh, everything's capped out there. There's a lot of opportunities elsewhere. They also can offer new types of content. Again, like I said, Netflix just looks at screen time. And that's, for example, why they've started trying to dabble into the gaming a little bit. They want your screen time. They want to add more services in so they can get into the gaming. It's been pretty soft what they've done so far, but maybe they're going to improve it in the future. Another thing that seems pretty obvious they could add in to me is something like what Peloton was doing with the live workout classes. And rather doing all the bikes and this and that, they could offer that as one of the types of videos you can get. So people looking for, kind of that live workout, that can just be included with Netflix. And also, they don't have any streaming content, which, potentially could be competition with Twitch and YouTube. It's just an idea of all the potential expansions they can do. Another very obvious one, which they probably will do in the future but don't want to add, is they're probably likely going to add a free tier in the future. This can be supported by ads and also limit the amount of content. Like, for example, if you have a hit series, that's because Netflix does create a lot of the top ranking TV shows and hit series, you offer a few episodes for free, and then people need to sign up for $1 for the first month to start getting the rest, and hopefully you hook the customers that way. And also, when you're targeting on a platform like Netflix, where you have very, very, very precise targeting to each person, and you can serve a different ads to them compared to the TV, you can garner higher advertising rates. And along with this and all this money they're spending on content, they are probably going to create some legacy content with, strong intellectual property similar to what Disney has. And they can create other revenue streams from merchandise or whatever else from those potential legacy content they create in the future. So this is why I'm saying that even just at 10%, if we look at it, it does seem quite reasonable of all the expansion opportunities they have and just what they're doing right now and the projections for their base business model. So maybe it could be higher, maybe it's going to be a little lower. Let's look at 10% for a starting point. But as you can see, 3, 5, and 7 really don't make much sense, and he has no rationale of where these numbers come from.
With 10, 14, and 18%. Free.
Next problem, why did he choose 10, 14, and 18% for the profit margin? Well, he kind of based it on the numbers that were previously there, but this actually makes very little sense. So let's look at Netflix's financials and actually get into how the business works. So when we go down here, let's just look at their gross margin first. Basically, it was about 2012, I think, where Netflix started producing their original content, and that's why their initial gross margin went down. But you can see this has actually been steadily growing over the years. And this is one of these things with tech and economies of scale. It only costs you so much to produce a series, but every additional subscriber you get, it doesn't cost you any overall cost than, maybe some server space, which is, very minimal. They're basically streaming it. But your costs are kind of fixed in how much content you're going to produce, but you can indefinitely expand your amount of user base and upping your profit margin. So as they expand, this is likely going to increase in the future. Even though every year they're spending more and more money, this gross margin is likely to expand. And also that's going to mean that their net margin is going to expand too. And when you look at even their net margin, they did have some better years and, some low ones. But I think this is going to actually significantly expand in the future. And, it could potentially get easily over 20%, 25% if you're thinking, 10 years in the future. And this is kind of how you have to think for profit margins is when a company's growing, you want them to reinvest into themselves. And that's good because A, it means they have a place to put the money to grow, and they're also not having to pay unnecessary taxes. So you have to think of not where their profit margins are now, but where they're going to be in the future. Where they're going to be in the future when the company's a little bit more mature and hitting more of that plateau in their growth. You eventually will hit a plateau, but I think in Netflix's case, they're still quite early in this stage, and this significantly can expand up quite a bit.
Cash flow margin. This is the hard part, guys. Let's go with 3, 6, and 9%.
And again, I explained previously the difference between the profit margin and the free cash flow margin are effectively going to equalize when Netflix matures. And this is how investors and analysts actually look at the company in the future. You're looking at where it's going, not what it's currently doing. So using the free cash flow margin of a company that's really low because they're reinvesting the cash into themselves and trying to base that for a current valuation makes no sense. And that's one of the reasons why he always comes up with these absurdly low valuations for, growth companies and companies that are reinvesting into themselves, which is what you want to see in a company.
PE. Now, guys, the average PE is 15. This company has a little bit better return on invested capital. Has a pretty good stake as I don't think it's a moat, but it's got a very good I don't go to Amazon Prime to just scroll. When I want to watch TV, I go to Netflix. I don't go to Amazon Prime. What's on Amazon Prime? Do you, Mo?
No.
No, I go to
That's
Netflix.
ditch effort.
I only go to Amazon Prime when I know something's on Amazon Prime that I want to watch.
I go there if I'm out of options and I'm about to go to bed. They're all right, you get one more chance.
It's kind of like going to the bar. You're searching for women, and all of a sudden 2 o'clock, you're like, okay, I got to make a decision here. Let's go. Nick, you know that, right? Yeah. All right. So PE, let's go with 14, 16, and 18.
Okay, this is the next ridiculous thing of his idea that, the average P is 15, therefore every company should just be around that and a little bit more. Well, first of all, the idea that the S&P 500's average P should always be 15 is just completely absurd. It's like, when you think that, that's complete beginner knowledge. It's basically saying, over the history here, as you can see, obvious being about 15, 16. But let alone the fact that there's a lot of factors that affect individual companies. You know, maybe in the case, even if it was an average 15, you'd have one company that should be about a 10 for a lot of fundamental reasons, another that should be a 20. So each company has its own PE based on a lot of fundamental factors. The fact is, for the overall market itself, the biggest thing that affects the S&P 500's PE ratio is the 10-year treasury yield, because this is kind of, you know, what you could get risk-free. So you can see the obvious correlation here of that when the treasury yield got very high, the PE went very low. And then as the treasury yield came down, it went high. And they actually have this on a little graph here showing how the distribution was. So yeah, there was times when the S&P's 500's PE was under 15, but this was almost exclusively when rates were extremely high. And when rates were lower, especially like right now, I think the 10-year yield is only about 3.3, 3.4%. So somewhere around here, there's actually very few times, the most extreme times where it was only a little bit lower than 15 were the extreme lows, but the majority of the time it's been much higher. Well, this is kind of the mean regression line here. So you could say, oh, well, you know, going out, it's that. Well, maybe it's a little bit more here, somewhere in the mid-20s, as we can just kind of see from the historical pricing. And this makes sense. I could do a whole video that would probably be very long on all the different technical factors that affect PE. But even one of the other things, like for example, is the accounting practices have changed, how things are accounted for and have changed over time. So using these long-term averages like Paul does of, oh, the PE or the price to sales over the PE over the last 100 years, it makes no sense. You have to look at it maybe in comparison with some factors, but there's a lot of different, you know, macro factors and accounting factors and individual company factors that affect this. So using this as an overall average for one basically stock and, you know, doing it for everything like that is just completely absurd. It's a company like Netflix, when it's more matured, you could probably easily garner a mid-20 PE ratio and just even show that the majority of companies actually that are even slow growth trade above a 15 PE. We can just actually look at Coca-Cola here. Just need to refresh this page here because it's being a little bit, wasn't using it's a little bit slow. But you can see Coca-Cola stock here over a period of time, and we can throw on the PE ratio. And let's just look at the 30 years because that's all it gives me. And you can see when Coca-Cola was like really going into the 2000 bubble, it was getting to a much higher PE ratio. But just look at the little number that's right here as I'm scrolling along. You can see a lot of times it's, when it was going up, yeah, it was trading very expensive. It got really high. It came down. But even here, you were trading mid-20 PEs, low 20 PE ratios. And this would have been a good time to buy Coca-Cola. And then in 2008, oh yeah, it comes down. A little bit lower here, we get into the teens. And the high teens is about the lowest Coca-Cola ever gets in. This little blip down here is actually because they had a one-time income and their profit margins were abnormally high compared to what they are normally. But typically in Coca-Cola's history, they've been at the lowest, low 20 to a high teens P ratio. So, and this is over 30 years. And you can see here, it's here, if you bought, you know, when it's like 24, long run, you're still doing fine. After the COVID crash, it hits a low of maybe about 20 and made significant gains since then. So this is kind of shows you, and you can do this for company after company after company, and a lot of good quality companies that have slow growth will trade for mid 20 P ratios. And if your claim is like, well, it's overvalued, well, you're saying it's being overvalued over someone's investment, basically lifetime, because this is 30 years here, and Coca-Cola is therefore being virtually overvalued for 30 years, which is probably your investing lifespan. So this just kind of proves this idea that PEs should be low, like Paul thinks it is just completely factually incorrect. And I'm just scratching the surface here of the reasons why. So let's continue the video.
This 18 is a very high PE, but if this happens, it probably has a big moat to it. So I'm okay giving it 18 PE and a higher return on invested capital. Now, desired return. I think all of these are hard, but I think it's 12, 15, and 18. So I still want a little bit.
So I don't agree with looking at what your desired return is. Each different stock is going to have their own discount rate because you have several different options. You can invest in a fixed treasury yield and get a fixed amount. Like you can put your money right now into a 10-year treasury bond and you're going to get about 3.3, 3.4%. But then different stocks have different risks to them. And something maybe like Apple or Coca-Cola is going to be perceived to be such a strong company, such good financials, such a large moat that the market doesn't need actually a very high basically discounted rate for it. So it may not want like a 10 or 15% discount rate, even though say the market goes up 10% a year, that's kind of the average. You can look at that as a 10% discount rate. There are going to be certain companies that are going to be under that. So, you know, maybe Coca-Cola and Apple maybe trade at a 5, a 6, and a 7. And if you set this too high, it's going to, again, look overvalued. If you set it too low, it's going to look undervalued. What's really important is finding what is appropriate for the market, which can be fairly difficult. And once you have that starting pace, then you want to find a significant discount from there, basically. Because even if a stock has only a 6% discount rate, and you say, well, that's only going to go up 6% a year on average, effectively, you can say, well, I'm going to wait till it gets 50% undervalued, buy it there, and wait for it to mean revert back to its normal value, which is generally how I like to look at things. And it's been proven to be quite successful in the past.
Extra. Even though this is very low assumptions, I still want a little bit extra margin of safety versus the 10% for the market. But as I get higher and higher, I want a bigger margin of safety. The stock's currently at 330. I hit the analyze button. Mo, what have you found before we do this? What have you found for anything?
The only thing I see here is we compare free cash flow and net income, noting that the major recurring difference are excess content payments over amortization, non-cash.
Again, they're trying to look in the okay, so I just had to skip through the last little bit there because they just basically kind of like babble on and try to understand the difference between the profit margin and the key free cash flow, which we're not going to go over again. So let's just get down to what their analysis is and their targets, and then I'm going to show you a very quick and easy way to basically come up with a more accurate analysis without using their whole fancy calculator. In fact, we can just use, you know, normal Windows calculator.
Attribute the cost of like creating their own, like Harry and Meghan. They probably paid them a fee for it.
Yeah.
All right. Okay, guys. Now here's our problem. I have a low price of 87 on earnings, high price of 160, low price of 26, and a high price of 80 on discounted cash flow.
So again, like his thing there comes up with just absurd values. Like when you're coming with a value of $26 or $50 for Netflix, you've done something seriously wrong. And even the huge discrepancy between $26 and $161 doesn't give you any tangible and valuable information. So I'm going to show you now basically how I come up with this kind of quick value here. So we just bring up our little calculator, and I'm only just going to go 3 years out because that's what the analyst estimates are. I usually only like looking maybe 3 to 5 years. Sometimes you can do a 10-year to get a very broad view of where things are going, but then that's getting into, oh, what's the total addressable market and this and that. But if you just reevaluate with the companies and see where things are going, you can buy it at a significant discount. I believe that's what you should do, since you can really only accurately forecast, because that's all analysts do, a few years in the future. So if I remember, they had about 42 billion, 300 million expected in 3 years. So basically, we take that number. I'm going to go for what their potential future matured profit margin will be. So even if it's not that at 3 years, this is what it's likely going to be going forward significantly in the future. And I think that reasonably can grow to about 25%. So then we get the overall profit about, you know, what it really is. And I'm going to give this a 25 PE. In reality, Netflix actually could be trading with this, you know, adjusted profit margin at a significantly higher P ratio, since, as we went over, something like Coca-Cola maybe only trades like, you know, the fair price averages at a 25 P ratio, and Netflix is growing at a more significant rate and has more opportunities. But I think it's a fair way to look at it, to be, you know, somewhat conservative, you know, way of looking at this without getting way too aggressive. So we get that, and we get a overall market cap in 3 years of about 264, 265 billion. So the market cap right now is 162 billion. So let's minus that out, get $102 billion of potential growth for the market cap. And then how much growth is that over the current market cap? Well, we're at about 63% growth in 3 years. So even without getting into the whole discount rate and this and that, again, it's a good idea to know kind of what the market's thinking. And the market is probably thinking under a 20% discount. I'm guessing Netflix maybe, you know, market might care about 15, but it's irrelevant. Right now, if you bought Netflix and you kind of believe these overall more reasonable assumptions, I would say, of probably, you know, what analysts in the market's looking at, you could potentially be looking at 63% growth. And obviously this is an outsized return to the actual market, or maybe, may not. But this also does, you know, the reason why you're getting such a larger return is if something goes wrong with Netflix and they aren't able to meet these expectations, and there's some significant change in the company and says, oh, we're not going to be able to grow profit margins, our growth significantly slows, something like that, you know, it may get revised down. But this kind of gives you an idea of where you can start your overall basis in your analysis. There are other factors to go through, the balance sheet and financials, but just using kind of the everything money Paul style of analysis, this is what I feel gives a more reasonable price for the stock. And what's that going to give us overall? So we'll just add 1 there to do that. The current price is at about 364. So times 364. And that kind of gives us a 3-year price target of close to $600. So, you know, this isn't, I'm not saying buy Netflix. Again, I own it right now. I'm planning on continuing of holding it. And, you know, I am probably looking at maybe more around $600, you know, plus potentially, because I do think that, you know, stocks go from undervaluation to overvaluation. I'm just not looking for a fair valuation. I want that overvaluation that I'm selling it into. But, and, you know, I bought it at a much significant more discount, so it's a much better deal. So that gives you a general idea of kind of how to use this discounted cash flow, which isn't really a discounted cash flow, but it lets you give a analysis of a stock and kind of project forward for a growth company like Netflix about where it could be in the future, assuming, you know, the current fundamentals of the company. So I hope you like this video. Remember to like, share, and subscribe. You know, leave me a comment. Tell me your thoughts. I want to do a lot more videos on individual stocks. One of the previous ones I did was on Scott's Miracle Grow, if you want to see how I look at an overall financial statement. But I might pop up more videos like this, more individual stock analysis. My current portfolio has over 50 individual stocks, which I think are fairly deep discounts, and those will be some of the stocks I'll probably be going over. So, you know, subscribe and stay tuned for the next video.